Okay, welcome everybody. I am excited today. This is going to be a new one for me. I've got Brian Leni on, not necessarily a company-specific interviewer today, but Brian Leni. I'm going to say if you don't know who Brian Leni is, but you've somehow made it onto my subscriber list, let me know and I'll buy you a beer. That'll make me feel pretty good because Brian Leni obviously is a very well-known name in this industry, right? If you do what I did and you listened, you cut your teeth listening to podcasts, you'll know this guy's name, you'll know his voice. Junior Stock Review, Mining Stock Education, right? He's got his fingers in a lot of pies in this industry, and I'm very excited to have you on, Brian. Thanks for showing up.
Thanks for having me, Matthew.
Yeah, so I mean, the kind of the crux of this conversation is that you got a new project, Field Notes, right? It's beautifully shot. I'll have to ask you about the drone that you've got and stuff like that, right? But beautifully shot series. I love the site visits. Intimate, well articulated, and useful, not just kind of puff pieces. Conversations with mining insiders, right? And so yeah, I'm excited to have you on here to talk about that, and maybe just a couple of things. A little bit of a grab bag here too, but. Maybe, if you don't mind, I mean, no place to start like the beginning, right? And you kind of do this in your first episode of Field Notes, but do you mind just telling quickly just kind of your origin story? Like, how did you end up where you are today in this sector that you're in?
Sure. Yeah, it's an interesting story. So I'm an engineer by trade. Out of school, I worked in pharmaceuticals. That actually didn't last very long, and I went to kind of like the polar opposite in terms of cleanliness. And got into the steel industry. And so I was a process engineer on the floor, working with the guys on improving the process line, specifically in the rolling mill side of things. I got a so-called promotion into management, and I took the promotion, and I ended up not liking it that much. It didn't take long for me to understand that, managing of people isn't necessarily for everybody, and that's something introspective, and most people have to learn by experiencing. So, at that same time, I'd kind of gotten into the junior mining world, first through gold and silver and monetary policy, that sort of thing. You go down the rabbit hole, and invariably, I think it leads most to junior mining stocks. And so I was dabbling in them while I was making money, and making mistakes and learning. And in 2013, I made a pretty big decision. If you recall, the high of the last cycle was in 2011. And at that time, I didn't really make that much money, and I didn't really lose any. I was kind of in that kind of even spot because I was making enough mistakes that it took away from what the bull market was doing. But in 2013, I said to myself, hey, the market's on this big slide. I want to make a discernible difference in my life. I don't like my job. And so what I did, and having an understanding wife was a big part of it, I sold my house and took 2/3 of the equity and put it into what I thought were the best juniors. And honestly, Matthew, there's a lot of luck that was involved in that. I seemingly picked a handful of probably the best performing juniors, in that uprise in 2016. And but mind you, I had to wait 3 years to get it. So I made that big change in 2013, and then if you'll recall, 2016 was the point where we really saw a change in market sentiment. And with that change in sentiment, I left my career in steel manufacturing and became an investor full time, and really haven't looked back. And so over the last 7 years, I've been sort of writing about my investments in the sector. And in 2020, I started a subscriber paid newsletter, Junior Stock Review Premium. And then just like you said, this year, I've started doing a site visit video series called Field Notes. And that's kind of my focus too right now.
Mm-hmm. And yeah, they are so far so good. You're only a few episodes in. I'm going off script here, but when does the next one drop? I'm eagerly anticipating it.
It's been tough. So I had another site visit scheduled, and it got pushed back, and that's kind of what I'm waiting for right now, is to get it done. And hopefully that's before the end of the year, but we'll see. These things, the market turmoil, the difficulties with raising money, and drilling and such, schedules are kind of all over the place. So I don't have an exact date yet, but I'm hoping before the end of the year.
No, and I get that too. Things are fluid when people don't know where the next dollar is coming from. Yeah, I mean, so I do want to talk about Field Notes, but I'm hoping that I can kind of just pick your brain about who you are and your story and kind of what you represent. I think that it's fair to call you a symbol or a figure in the industry that people know and want to learn from, right? So, which maybe, go back to 2012, not what you were expecting to be, 10 or 11 years in the future, but here you are, right? But maybe just, not to get out of order too much, but you even mentioned, it's kind of funny, you said you cut your teeth in pharmaceuticals. And you kind of already answered this, but what drew you to junior mining in particular, right? I mean, there's lots of other kind of penthouse or outhouse microcap sectors, fintech, yeah, pharmaceuticals, right? What happened here that took you here and not, yeah, pharmacies, I guess?
Sure. So really, it was during the, I guess you could say, the courting process with my wife. I was at her house for the first time, and I met her older brother, and we got to talking. And he started talking about gold and silver and monetary policy and this guy named Doug Casey. And I was kind of overwhelmed, like I'd always been, well, I wouldn't say metals oriented, but of course, taking engineering, I know I've got some metallurgy background. I'm interested in it, but I never really focused on the precious metal, especially. So I started hearing this guy who I know is smart, but at the time I thought to myself, seems smart. And so I kind of went down that rabbit hole. So that's where it started. And then invariably, I think when you start, especially if you attach to a guy like Doug Casey or some of the talking heads that talk about monetary policy, I think invariably they flow you into junior mining stocks. And I'll tell you, it's completely different. And I would say, it's like a word of caution to investors or people that are interested in monetary policy. Junior mining stocks and monetary policy and precious metals, the reasons for owning precious metal, physical metals, or some sort of derivative of physical metal does not coincide with junior mining companies. It's totally different, and it's not for everybody. But for me, I was hooked. And unfortunately, one of the first things that happens is I doubled my money on the first investment I made. And I'm telling you, like, it was probably about the worst thing that could have happened. And, in retrospect, I remember listening to Rick Rule give a speech, and he said one of his terms is, confusing a bull market with brains. And I didn't get it when he first said it. And then after, I was like, oh, you know what? That's exactly what happened in those early days. And I was pretty loose with my investments, especially to begin with, because it had come too easily. And so, unfortunately, one of the things that I think probably everybody has to do is lose some money first. That it really makes you be more discerning in what you're going to put your money in and have a better plan. And that's exactly what happened to me. So.
Yeah, no, it is a good phrase. He's got a couple of good aphorisms, the Rick Rulisms, and I think that's one that carries value, right? Is don't mistake macro sectors for your own genius, right?
Right.
I got to ask. I mean, so what are, just out of curiosity, what are some of your W's that you got that you hang your hat on? Like, what are some of the names that you pulled out there in the early times?
Gold Standard Ventures, Ivanhoe Mines, Reservoir Minerals. Orion Resources is that first iteration. Again, there was a couple Ivan Bebek stories, so it goes back to Keegan, Caden, and then of course Orion. What else? I don't
What
know.
about a bit?
Those were the big ones. Those were the
Yeah.
big ones. Like the Reservoir Minerals was big enough. Like that was the down payment on my house when I rebought. And so there was some significance to those ones. And Ivanhoe was like, I remember buying that at 75 cents. And I think I sold probably the most of the position in the like $5 to $6 range. So, like when you have bigger wins like that, those are the ones that sort of stick out.
Yeah, absolutely. And so I got to ask, flip side to that, big L's. What's your capital L?
Oh,
Capital
the
L
big
losses.
loss.
Yeah.
Well, would you like in percentage or monetary?
How about the one that stings? How about the one that, like, the one that got away, or the one that kind of sticks in your brain, or the one that, yeah, that stuck with you after a bit?
It's probably the stuff that's happened lately. Like there's a couple companies that I should have. Oh, I'll give you for instance. So I have some connections to Canstar Resources, it's a Newfoundland exploration company, and there's a few reasons why I got into it. The basis of the project, the people that were involved, some of the investors that were involved, got in there. And this is like if you look back when that company got restarted with Rob Brugman at CEO. Newfoundland was super hot, and that thing went from 18 cents, I think, is where the placement was that I got in and where I started coverage in my newsletter, and it went up to I think a high of 60 something, and I did not take enough profits on that top end, and then it just fell apart, you know. And I should have seen it coming, but it's one of those things that can get away from you. And I regret not taking more profits off the table. If you want to talk about de-risking, especially when it comes to expiration, I think when you've got like a 200% gain or even 100% gain, those are opportunities for you to take money off the table and sit there with house money and just say, hey, whatever happens with this, I don't really have to worry that much, because I got my principal back. And depending on what's going on in your portfolio, you can know that, but still make that mistake. And I regret not taking more off the table. So it did sting a little bit extra.
Mm-hmm. Yeah, no, that's those are the ones that always get me too. It's not the losses, it's not the realized losses, it's the lost unrealized gains that always seem to kind of stick in my brain, right?
Right.
But no, yeah, I kind of warned you, and I'll give you credit. I'll credit you on air here. I had offered to let you see a couple of questions in advance, and you told me heck no, right? But I did warn you. I wanted to talk about just risk mitigation, right? And so I'm glad that you kind of are kind of taking us in this angle, and I'll chase that rabbit if you wish, because I do want to talk about field notes, because it's a really cool project. But why don't we just move into risk mitigation? Because I think that's already a question that's coming up. I've been writing these down feverishly to make sure that I remember, in 15 minutes from now. But one of the questions I wanted to ask you in terms of, reflecting back on your time, like you are a success story, right? And I mean, it was almost the same thing, like a professional athlete, whether you wanted to or not, your success has made you a role model for people that follow you now, right? And so your actions and your decisions and your choices, have larger consequences than just your own life, if that makes sense, right? People look to you for guidance, I suppose, right? Which, like I say, can maybe be a little daunting, but you mentioned Ivanhoe, 75 cents to $5, right? My question that I wanted to talk to you about is risk mitigation, right? When do you de-risk? Like, if we're going to talk about kind of concrete moments, you obviously then don't have a set, I double my money. I double my money, take half out, or sell half my shares to break even and carry house money. I mean, do you have what is your guiding principles around when to de-risk?
I don't have a set necessary plan. It all depends. Each company is different, and each way things are going to unravel is different. And the market at any moment in time is different. And so, like all those things that we talk, whether it's selling on a double or selling on this or even a 20 or 30% gain, sometimes I do that depending on the outlook. I see how the market's behaving. If there's some other like external risk that has popped up, maybe it's jurisdictional, maybe it's whatever. So there isn't one piece to the puzzle or one thing that I could say, okay, you do this. But what I'll say is this is I've said this numerous times in presentations. It all starts with the individual investor. And I think if you get that right, then you're going to be way ahead of the rest of the market. So what does that mean? So what it means is you first start with yourself and what your understanding is of the business, what type of company you're going to invest in. So, if you're picking exploration, obviously exploration is at one end of the spectrum of risk. First, you have to realize that. And second, you have to realize the knowledge you have to understand the drill results you're seeing, or if you're getting a bunch of soil samples or grab samples. Do you know what that means? If you don't, but you're still willing to make the risk, it's a bad combo, because I think that's how a lot of people end up losing money, because the exploration is very sexy. And especially if you have a good promoter, like these guys really, really know how to sell, and it can be a really bad combo. And that's unfortunately where I think a lot of people get attracted to this business. The generalists or the general retail, they hear a splashy result. They really don't know what it means, but a good promoter comes on, he says, oh, this is 10 million ounces. And they get in it and they end up losing money. Really, I think, you have to be cognizant of what you know and what you don't know, the risk, and also the timeline for being right. So if they've got a bunch of catalysts, and one of the catalysts is the completion of a metallurgical study, which they're going to increase the recovery using such and such process, but it's three-phased. A good company, as an example, is FPX Nickel. I've been a long-term holder of FPX Nickel. Metallurgy was a big sticking point, and maybe still is for a lot of investors, because it's a wearerite nickel. It's not a sulfide. It's not a laterite. It's a little bit different. They had a three-phase program that took probably the better half of 2 years to complete. And really on that phase three, if you thought you were going to get the yes answer, or even whatever answer you got after phase one, the market probably didn't even care. And so you had to be willing to wait 2 years to get that yes answer at the end of that phase three trial. And maybe even then, if the answers are what you want, depending on what market you're in, you still may not get recognized. In FBX's case, they did, and they've seen some great share price appreciation. But it's a great example of how, people will say, okay, I want to make 100% on my money, and I want to make it in the next 3 months. Like, well, good luck, because you're probably going to be on the expiration side, and you're going to have to take a ton of risk to get that 100%. Whereas if you find a good company that's got all those other intangibles like good people, cash, and a plan, and then you have a realistic timeline to making that 100%, and it's probably not 3 months unless we're in this rip roaring bull market. And that's what I think. Another thing people have to understand is where you are in that market cycle, because a bull cycle is completely different, or the bull portion of the cycle is completely different than the bear cycle. And in these bear cycles, most of the stuff that's gaining traction is expiration based. And again, there's differences between full out grassroots exploration and then companies that have delineated some sort of resource or have a PEA and they're expanding. So the two different things, and you have to know where you are in that cycle. So all those things go into self-awareness, and if you get all those right and you're honest with yourself, I think that almost sets your stage for how you're going to de-risk that company in the future. Because if you say, oh, this is going to take 2 years for this 3-phase metallurgical program till I get that yes answer, then you should be okay with sort of riding the waves up and down and holding your position. Now, it doesn't mean it's going to be right or you're going to be right, but that's the reality of how the market works. And then so again, if you get the self stuff figured out, I think it sets the stage of how you're going to de-risk. And then you can add the intangibles, like maybe having a market view and taking more money off the table if things start to get rocky. Like, let's say in this last 2 weeks with what's going on in the Middle East, maybe for some people that have let's say they own a company that's in the Sudan or Egypt. Egypt's a pretty hot exploration. I don't know if you know much about the gold exploration going on in Egypt, but it's pretty exciting stuff. It's like a brand new frontier they've opened up. For me, I was looking at a private company investment in Egypt. And for now, I'm putting that on the side table, because with what's going on and what Egypt's involvement may or may not be, to me, it's not worth the risk. So I think, again, you start with the baseline, and then as you get more comfortable, you gain more knowledge, then you can start adding intangibles to that, such as jurisdictional risk or whatever else might be going on in that specific metal market that affects that company.
No, well, I mean, yeah, well said. And there's a bunch that I want to jump into there, but maybe I will focus, like you say, kind of what you were saying about just knowing yourself and who you are, right? And so for me, I think that the thing that I always harp on is the utter and desperate need for patience and the control of your emotions, right? That I think that impatience and greed that you kind of referenced, right? That people want that you go to exploration and discovery plays because you want that 100 the 2, 3, 4x in 1 or 2, 3, 4 months. But so that greed can be a dangerous thing. But then also on the other side, when you are in the doldrums and you are in a moment of despair and that bad habit of always selling at the bottom that I think lots of people have. I guess maybe the question I have is, is there a way? So, I guess myself, I guess it was just experience and maybe a little bit of my own personality where I'm decent at managing or controlling and articulating my emotions in a way that lets me not let them control my guide my actions. But I guess for yourself, is this a matter of different personality types doing better or worse in different sectors? Or is there just when you first started out, were there skill sets or habits that maybe you tried to develop or acquire to help manage that portion of things?
So first off, I would say there probably is different personality types that suit investing and others that don't. But I do think you can set up a system for yourself to sort of put you in a position to better be better or more successful. So one of the things I started off with doing, especially early on, is like I literally had a piece of paper on the side of my desk, and I had a set of rules that I wrote down. And one of them at the beginning was, on a double, I take half off the table. Mm-hmm. And it's just if you do a rules based, or if you have a rules based approach, I think it cuts out emotion, because if you say, okay, look, I don't care what's going on. If you can make that deal with yourself, I don't care what's going on, I'm going to trade according to these rules. So maybe your first rule is, I only buy companies that are selling at a certain discount to value. Because one of the big parts, it's not necessarily de-risking, but it's coming in at a good price. Price is the best de-risker out there. If you can buy stuff cheaply, then you're sitting in a much better position. So if you're looking at those kind of asymmetric plays, then you put yourself in a really good position. So if you can come up with a figure, it's like, oh, I need something that's selling at, this is 25 cents on the dollar. And that's the price. And if it's higher than that, I don't touch it. And then another rule is I sell on a double. Okay, now you've just kind of de-risked yourself. You've bought something that is already cheap, but has, we can get into the ingredients for a good company, but has all those ingredients. You made the thing, and then you're going to de-risk it on a double. Right there, I would say if most people probably did that, they'd be sitting pretty good in terms of their P&L at the end of the year. And so those are the kind of things that you can do. And you can become more nuanced with that rules-based approach. But literally, that's what I did because I had to come up with a system that was repeatable and kept me in kind of that box of how to deploy money and how to take money off the table. Like I tell you though, Matthew, like one of the biggest things I learned, and it was from a friend and a mentor, was learning how to sell. So many people are obsessed with the buy side, and the buy side is super important. But I'm telling you, really, for me, and it was probably 2018, 2019 when I really got what he was trying to tell me about selling. And it's so important. And that's, I think one of the things that's helped me is the fact that I write down everything about my investment. And I have kind of this anchor to my audience in terms of being responsible for what I say and what I invest in, because it really makes me think about it and articulate it so that I understand it. And I think that's probably another thing that people miss is that they'll have something formulated in their head and they have some foggy idea and they're like, okay, I'm going to put the money in. But then you put it on paper. If you're trying to sell it, the idea to somebody else, that's really what probably would crystallize it. And even if you're not going to publish the report, like you don't need to do that, but you should be able to write it and hand it to somebody and say, this is why I'm invested in that company. And if you can't do that, then there is a missing link there. And you're either in the wrong type of company or maybe you shouldn't be investing, period.
Well, and that's a great transition too. I mean, like I say, I got a little chicken scratch note here of things that I want to ask you about. I mean, then that one, the necessity for, and it's not just geological knowledge, which was maybe where the conversation was going for me, or the question started. But I mean, I think maybe in our previous conversation I mentioned this too, like the Dunning-Kruger syndrome, right, where people with moderate or low levels of knowledge, not realizing what they don't know, think they have a high understanding of a certain topic, right? And that's my concern and that's my fear. And I guess I take a certain degree of responsibility for people too. I want retail to succeed. I want people to make money. I want everybody to that dream of financial freedom, which is why people come here, right? And my concern is that greed, it always comes back to emotions for me, clouds your judgment and makes you make these rash decisions in pursuit of upside when you don't know what you don't know. And you said yourself, like the knowns and the unknowns, and trying to understand those. I guess what's the question I'm coming to here? What categories or knowledges do you think? I mean, maybe let's break this down and chunk it out. Maybe just part one is, do you need to be a geo? And maybe that's not a formal PGO with a 4-year degree, but like, do you need to have, how strong of a geological basis do you need to have to succeed as an investor in this sector?
I think, okay, I'll split it. I'll say, like, if you want to invest in a producer or a royalty company, I think it's mostly balance sheet analysis that you're really going to have to do. Like that's the bulk of the analysis, again, in my view. So do you need the geological backing? It never hurts in this industry, but I think on that end of the spectrum, I think you can get away with it, no problem. The developers, which I would call anybody that has, let's say, a resource or some sort of economic study. I think it's a mix. Like it is the truly in between ground where I think, again, more geological knowledge is going to help you, but isn't necessarily going to be the backbone of what that company's all about. However, it depends what catalysts you have for that company to be successful. Now, if it's exploration, you probably have to have somewhat of an understanding. If they've got, let's say, 1 million ounces, and they really, to get critical mass, they need to get 1.5 million or 2 million ounces. Being able to understand if that's even possible, whether it's down dip or whether there's some lateral extension of the deposit, what are the odds of it actually expanding, or if maybe there's a satellite. That's the kind of thing. If you're gonna put your money into that company and know that they have to expand that deposit, that's a geological type of decision, or the probability is totally linked to geology. So I would say in those cases, yeah, unfortunately you do need probably a fairly high acumen in geology. On the other side, if it's a 4 million ounce deposit that has critical mass, that has a PEA, and really these guys are, they're just going through the steps towards feasibility study and construction decision, and you're buying in a market like this that is depressed, and you're probably buying it on pennies of the dollar, well then, it probably doesn't matter that much, if you have that good of knowledge. Now, again, all that stuff helps. Like if you can read a technical report, which I imagine most people don't do, then these things are going to help you. But I'm just trying to make the point that, again, it's a sliding scale. And then the far end of it is the exploration. And in many cases, you need to have a good understanding of what exactly you're dealing with. I think you can set up, like in terms of grassroots, let's say, I think you can set up some pretty basic criteria of what you want to look for. But then if you were going to gauge potential between, let's say, a handful, you got 5 companies in a spreadsheet. So how are you going to differentiate which one that you invest in? Well, it's probably going to come down to not only the people and how much you know about them, but also what the potential is on those plots of ground. And again, that's going to take some geological understanding to get. Now, again, with all these things, if you pick the right people, and if you know these people, and now to the general retail investor, this next point isn't going to mean much. It shouldn't mean much. But for someone like me, for instance, I'm an engineer, not a geo. I've done a fair amount of reading on geology, but I don't profess to be an expert by any means in geology. But I'm more comfortable with people that I know. If I understand who the person is, if there's a level of trust, I'm more accustomed to trusting the things that they tell me to a certain degree, and I won't be always looking for another opinion on a drill result or on a soil sample or whatever. But I do, at least I do have access to people that are geologists, and I can ask them questions if need be. But I think if you get those people right, and there's a level of trust that you can count on, then I think it makes it a little bit easier to make some decisions that might border on what you need a geologist for.
Mm-hmm. Yeah, excellent. I mean, a couple of things you said there. I mean, I can't agree enough about this. It's such a people industry. It's funny, all the geological data and years of above and below ground exploration, but really comes down to people for me. That there are people that I do trust and I don't trust with my money, right? And I think that maybe something that I'm trying to articulate myself is that I think a lot of new investors are very flippant with their decisions and the money that they are putting into the market without without being cognizant of what exactly they're doing, right? And so yeah, just that need to trust. But I have an interesting question for you, because this is another thing that I always laugh at. I mean, reading technical reports, what a concept. Reading things that the company's produced, right, to learn about the company, right? And it's always on social media or in my own correspondence, people asking me where I get this information. Well, it's in the annual information form, right? Or it's in the technical report. I mean, to check these things out, right? And so I mean, not really a question there, but I mean, if I'm trying to have a conversation with you about things for people to do and to improve their own kind of their own jurisprudence, read the damn reports, right? But I guess maybe the question I have for you is, I want to kind of get inside your head as let's say it's day one, you come across an interesting story, and I want to maybe try to understand that process where it comes from, first time you've heard of a company to, X amount of time later where you consider yourself to have achieved a full position, right? I guess, how long before you make and again, I know there's not necessarily a hard rule here, but how long typically is it before you discover a company to you make your first buy? How long is your due diligence process there?
Well, first I'll say, if I don't know the people at all, it's much longer.
Yeah.
If it's linked to people that I know and that are involved, or maybe if there's a friend or somebody that I know that I respect and I respect their opinion and they're putting money in, that goes a long way with me. And it's not that I don't do my own research, I do, but some of the points that I might deliberate on more for a week or two, it's like, okay, if he's okay with this aspect of it, then I can be, or maybe I go with a lesser position or such. Yeah. Mm-hmm. So there isn't a hard, fast rule, but I would say for the companies that I don't know, it can take a while, especially in this market. I'm in no hurry to make a hard, fast decision. And usually what happens is Like the first thing I do is go through and I'll compare market cap. And if the company has a technical study, I'll look right away to what the underlying MPV is, after tax MPV is, and compare it to the market cap, where they're trading. And if the differential is at that high level is good to begin with, then I'll look at it, like who the people are, how much cash they have, maybe G&A is another thing. Like you can tell a lot by a company by the salaries that they take. So looking at their their information circular that comes out yearly, again using CDAR to your advantage and looking at this stuff. Usually I'll have looked at that stuff before I have the call, but then I'll go to a call before I do a DCF or anything like that. I'll do the phone call, and even though I know how much management's taking, I ask them how much are they burning, how much money's going into the ground, these sorts of questions. And then depending on how they answer, because I've had some guys, maybe they weren't lying, maybe they just truly didn't know. But there's certain things like that are kind of like disqualifiers for me. So, and some guys get offended by me asking about salaries and such, but that's kind of the flow of how I go. If I don't know the company at all, it's kind of that high level stuff. And if it piques my interest and it's get a phone call, that's over probably a 1 or 2 week period. And then for these companies, kind of where I like to stick and do most of my investing is kind of in the developer. So, from basically a maiden resource type of stage to feasibility study. And then, so depending on where they are, I like construct my own DCF, play with the different factors that I think might affect the company and where they're going, and then see what that differential is. And then it's probably another follow-up call to kind of rejig my DCF to be a little bit more stringent. And then, of course, I always do a pretty big discount on my own analysis because I know I'm going to make some mistakes. But that's sort of the process I go. So it's quite variable. It can be a week and it can be 3 months. And that's the kind of thing. But like right now, like I said, most of the companies right now that are new to me, they go into a spreadsheet, and there's a few high level factors that I look at, and I'm just monitoring that. And then I'll have maybe some prices that I'll focus on. If it hits that price, it's like, oh, you know what? Maybe I do need to make a decision on this because it's selling so cheaply. So that's kind of my process. And again, it changes when we're in a bull market, because in a bull market, I think you can be a little bit more loose. The problem is, especially for the general investor out there, you probably don't want to let those habits, being more loose, come into you too much, and neither do I. But I'll be honest, like it does creep in when that bull market strikes. So yeah, that's kind of my process.
Yeah, no, excellent. Thank you. And I mean, I just like, again, just reflecting on that, if you're doing, if you are reading technical reports and calling the company, you're probably doing more than 95% of journalists who are in the sector, right? And so people looking for an edge, knowledge is your edge in this sector. And again, people do themselves a disservice when they don't do these things, right? Or at least in my thoughts, right? So maybe, on the other side of that coin, flip side to that is, I want to talk about dollar cost averaging, right? Is that so you've made your investing decision, you have you've got your little starter position done. I mean, how many tranches do you buy in through? How long does it take? I mean, maybe my more overarching question I have is like how much cash you keep on hand as a general rule. But yeah, how patient are you in buying in? Of course, yeah, this is going to change based on bull or bear. But yeah, like right now, if you're going to start buying today for company A, how many tranches are you looking at before you consider yourself to be fully invested?
So again, I don't have a hard fast rule on that. It just depends, and it depends on a number of things. It depends on how much I like the company, how close I think the catalysts for share price appreciation are. It depends what's going on in the world, and the financial markets, to how people are putting money into the market or not putting money into the market. Like I said, if you wanted like right now, I'm super slow at doing it unless there's like a catalyst. I haven't found a company yet that has necessarily that catalyst that I would say, oh, for sure, like this is going to spur market interest. Because I think what you're seeing, especially right now, the market is highly volatile, and there is some of the news, even good news, outside of like a really banger of a drill hole, is being sold. It's liquidity. It's more like last year in 2022, where everything was basically a liquidity event. So in those instances, I'm pretty slow, and it could be 20 tranches. If it could be like super small positions to get up to that maybe 5 or 10% range is where I like to bring positions in terms of my portfolio. And those are my wheelhouse type positions. Expiration is probably, it depends on the company again, but I'm less prone to having expiration companies occupy more than 5% of my portfolio. And so obviously it can be quicker in accumulating an expiration company than a developer. But again, I guess maybe the overarching thing for me is just, I don't think especially the more experience you get, I don't think there is any hard, fast rules. I think
Mm-hmm.
very early on, if you want to be successful, it's probably good if you do set yourself some rules and keep yourself in this kind of box. But with maybe the comfort I have with myself and in the market, I feel like I can kind of move with the market to a degree, and it's taken time for me to get there, but it's definitely not for everybody.
Mhm. Well, I think that, I mean, fundamentally, it's accurate, right? That as the story changes, as your investment thesis changes, to the positive, why would you de-risk it half if it hasn't achieved a fair value proposition? That having a doubling, and it makes sense. I guess maybe I'll tie this up soon here because I do want to talk to you about field notes. But I mean, I just maybe on a couple more questions here. Just looking back, and you kind of again, this is a decent transition here. But looking back at your earlier years, if you had a chance to do things over again, or if you could have learned from your own mistakes in some fashion, you can reflect on that. What are some things that maybe you would have approached differently, or knowledges you wish you'd had before you jumped in, kind of thing? What are some reflections that, if you could talk to Brian Leni from 2012, that you'd tell him, or from?
Uh, it's so hard because I don't know if I could. You learn through experience, for the most part. So I don't know. Like, I learned a lot by listening to podcasts and stuff like that. Like, that's really how I cut my teeth and made the transition. But being a full-time investor, it's been such a different journey, and I've had to make some mistakes and really learn the importance of selling. And you can't. I don't think you can necessarily do like I because this is the problem. Is I think people will end up blowing themselves up right at the
Yeah,
beginning,
yeah.
and they don't even get a chance to learn anything because they lose the money so quick. And I think one of the big things about junior resource sector investing is because it's so cyclical. Again, you have to buy when things are low, and you have to sell when things are higher. And it doesn't necessarily have to sell in the bull portion, but that's ideal. But when you're making money on your investment, you have to take profits off the table, and that looks differently. All the stuff we talked about. So looking back on that thing, it's hard for me to say because I wish I could just transport myself today and then back then because I would have done a lot better. but all those things kind of came in the timing that I needed them to come in. And I think the biggest thing for people is if you've got, let's say, $3,000 to invest, don't put $3,000 into one company. Don't put it into three companies. Unfortunately, you're probably looking at maybe 5 to 8, and it's small, and you're not going to make a big difference yet. But I think the bigger point is that you're going to learn how to move money in the market, and these are the kind of environments that I think that you can learn a ton. And you have to be cognizant, and I think you have to write about what you're experiencing. Like, that's another thing I was doing more so back then, was I was kind of journaling about my mistakes and mostly about the negative and what I was doing wrong. And really, that's what brings stuff to the forefront. When it comes to like mentors and stuff like that, I'm 100% like, if you go back to prior to 2016, 2017, I had no contact with anybody that I considered a mentor. It was all via, the internet, through YouTube and podcasts and whatever. And I had to make those decisions. But what a difference it made when you had somebody else to talk to. So what I'm trying to say is, again, mixing in with what you're doing on the investment front. I think you have to go to conferences. I think you have to meet like-minded people that are invested in the same thing, and understand how different people are making investments. What they think about your investments, and be open to criticism on what you're invested in, and go from there. And all these things sort of leads you down that path that each individual is going to have to make. So, it's a really tough question, because I would want to transfer myself back and say, hey, look, I got all this knowledge now and I'm ready to rock. And I do know how I would do it differently. And I think one of the big things maybe is, but again, I don't think it's realistic that to do it, but I would be more concentrated. Like that's the thing. Like I was spread out in probably at different points. I was spread out in probably too many names, and then when I was right, I put all this time in. I didn't make a big difference, or it didn't make a big difference. And I think at some point you need to transfer that. You need to go from 1% positions in all your companies to taking 10% or 5% and making the certain. So when you're right, you're right. But there is a flip side. When you're wrong, you're wrong. So that's probably one of those bigger points. But like I said, everybody has to kind of go through their own journey. And then I think the biggest thing is to make sure you last long enough that you can kind of experience the ups and downs of the market, because that's what you need to be a concrete investor. And honestly, now kind of being in the second cycle of my investing career, I can just see, how many more lessons that I'm learning now, and I do this every day. So, there's so much to learn, and it never stops. So.
No, excellent. I mean, yeah, I mean the what you say about don't blow up your account. I mean, it does resonate with me a lot. It goes back to that greed and that emotion and the desire for people to make that life changing amount of money, not realizing that even if you can beat the S&P 500 by multiple orders of magnitude, and it still takes you a few years to get there in this sector, right? To get to that life changing money people are kind of tantalizingly chasing. Maybe this is we'll end here, but just one more. Just how many positions do you hold then, right? I mean, you're kind of chatting about 5 or 10 is your major for your major buys. What's a sweet spot for you?
Well, it depends. It really depends on how many exploration companies are in my portfolio. Right now, I've got 14 companies in the junior stock for premium portfolio, and it hit a high. I think I had 18, which is like the peak of what I like. It's just hard enough to keep up with 14, let alone 18. So right now, this is a pretty good position. I'm sitting just under 10% cash, and I'm definitely willing to deploy. Like I've been buying small tranches in basically my top 10 companies that are in the portfolio. It's one thing I do is I rank the companies, and it's according to different criteria, and it's constantly changing. But that's usually I've got a higher weighting of my portfolio, so it can exceed or go down. Like even developers, there's a couple of developers that have kind of been laggards, and I've dropped the percentage, my personal portfolio, to concentrate that money into companies I think have better catalysts and more market recognition, and so that's kind of how I've got my portfolio focused, and oil being a pretty big focus, and considering the things that are going on today, that might end up being a better investment than I even thought, but we'll see.
Yeah, fair enough. So why don't we, now that we're 40 minutes in the conversation, do you want to tell me about Field Notes, right? I mean, so yeah, like it's a great, I really like it. Yeah, it's gorgeous to watch. It's great conversations, great stories. What was its genesis? How did this come about? And then I guess, what are you hoping to build with it moving forward?
Sure. So the genesis, it goes back pretty far. Site visits. Well, actually, from the very beginning, throughout my career in steel manufacturing, which was about a decade, I loved going to other plants. I loved going into the field and seeing what other people were doing and bringing that stuff back. And then it kind of parlayed into the investing world, and especially with mining companies, doing the site visits. And early on, I saw in 2017. So this is like less than a year into my full-time investor foray, and I did a site visit, or did a tour myself. I funded it, everything. I went to Newfoundland for well over a week and went to, I don't know, 4 properties. And I met a bunch of different people, talked to some other investors, and I was like, wow, you can't beat it. Going to sites, seeing the stuff, like you can see pictures and aerials, and you can get a feel for it. But then once you're there, your boots on the ground, you can see the changes in topography. Like for one, I was an early investor in Anaconda. I say early investor. I was in 2017, that was before a lot of people were talking about it. So I was out there, and Point Ruse was a really interesting project. Like the topography of it, I don't know if you know Anaconda or now Signal, but their Point Ruse project just outside of Bayvert was really interesting. And the way that the tailings pit was, and kind of where the mill was, and how everything was set up, its proximity to the different communities, its proximity to the Ming mine, these different things. So you could never replace being there. And so from very early, and I had the idea, like, I'd love to film this at some point. And I actually did film part of it, and it just never went anywhere. I didn't know how to do anything with video. So fast forward that to today, and I thought, we're at the bottom of a market. I have a privileged position in being able to access site visits. I want to bring my readers along with me to site, and I want to do it in a very classy and maybe different way with this kind of docu-series style. Mm-hmm. And so episode 1 started off with a good background on me. So if you're interested to know more about me and my story, you start with episode 1. And then episode 2, we fly out to central BC to see FPX Nickel's Baptiste Nickel project, which is, of course, in the Dakar district, just outside of Fort St. James. And again, I think it's an excellent video. It shows the different aspects of the project, how you get there, the communities that are going to be feeding this potentially with labor in the future. And then you get to know a little bit more about the people. And I think that's, again, another big aspect about investing, because you see these people at conferences, and maybe it's a very very professional type meeting where you just talk about the company and maybe don't really know what the person's all about. While in the video, and then if you ever get to go to the bar or something like this with these guys, then you kind of sort of see the real person. And that's the other aspect, is to learn more about these people, see them in sort of a different view, and what you can gauge from that. And so that's what I'm trying to relay to my audience, and that's what I hope to do with this series, is bring you to the companies that I'm personally invested in, and see if you see the same reasons for investing in this company as I do, and try to do it in the best form possible. And that's with the film crew that I work with.
Yeah, and I mean, so far so good from that. Yeah, good stories and stories told well, which is a pretty neat combination. I guess maybe like the question I want to ask is, I mean, again, trying to focus on the fact that you are a spokesperson of sort for retail investors, and people look to you. What do you like? What do you hope people's takeaways are from this process or series from you? Like, what do you if they're going to learn or be better at investors or something, what are you hoping that they gain from this that they can take with them to be meaningfully different or better as investors?
Well, I think the baseline, if you look at the FPX video, the points that we cover, whether it's myself or Martin talking, are the points that I think that investors should be looking at in terms of how they make an investment in any junior company. So that baseline process of how to kind of go through a company, I think is present, and it's done in a story format. So I think that the viewers are sort of learning the process without even like sitting there and saying, hey, writing down necessarily notes. Like if you see the stuff that comes up on the screen, the stuff that Martin's talking about are the key points to that process. So I think that's one aspect. Another aspect is just looking where someone like me is putting their money. And see if you can, if you do see the value in mirroring those kind of, it doesn't have to necessarily be in those companies specifically, but companies like that, that have, let's say, large resources, well located, maybe have some X factors, because I think in this market, there's a lot that's lost in mediocrity. And I think that you have to find a company that has maybe what you call an X factor, or something that differentiates themselves from the pack. And I think like company with FPX, for instance, it's also one of the things that strikes against it is that Awareite. Okay. The fact that it's a different type of nickel mineralization has a lot of people scared, but the other side to it is it's also what makes it such an unbelievable project. They're going to make a high grade nickel concentrate. So it's going to be a 60% nickel concentrate. Well, that nickel that's in contrast to a nickel sulfide, which is like between 10 and 15%. So they have 4 times less trucks or rail or whatever per load of nickel than any other nickel sulfide out there. They're got access to the Pacific. They just did a JV with Panasonic and Toyota. The reason why they're doing it is because of that low carbon footprint in comparison to everything else. The awarenite, when you process it through this, we're talking basically magnetics here. They separate the nickel from the iron ore essentially, and what you're left with, one of the minerals in there is called brucite, and brucite has a natural tendency to sequester carbon. Now, there's variables on how much carbon it can sequester, but there is a natural sequestration without any added energy. And so these sort of things are the sort of X factors that I think in this environment that is so concentrated on environment, I think separates FPX from its core. Because if you look at the baseline mineralization, it's like, oh, it's extremely low grade. Correct. But it's huge. It's right at surface. The strip ratio is less than one. There's a lot of things again that are very good about it, but would probably get lost in the minutia if it didn't have those environmental X factors, and I think will really matter in today's environment. And so those are the sorts of things. And like a lot of the investments that I made, if you looked at the company, there is certain reasons why I picked them. And if you can pick them out, I think, again, those all help in anybody's process towards being more successful consistently.
No, well said. So, I mean, can I ask for a sneak preview, upcoming companies or themes that maybe you're going to explore in the next while?
There's definitely a few companies, and the first quarter of next year should be really good. But until it's written in stone, meaning that they've 100%, I don't want to speculate, because I've had numerous emails, like probably 5 that look really good, and there's some rough dates set. But again, until it's kind of set in stone, I don't want to look stupid. So.
Yeah. I know. It's my interviews. They are not a go until the recording button has been pressed. That's kind of
right.
Yeah,
right.
Totally right. Go for it. No, you go.
No, I was just going to say that there is a few episodes that should be shot, and I would say in the next 4 to 5 months that are like some really, really good companies, and I'm looking forward to shooting those videos. But again, until it's set in stone, I don't want to speculate.
No,
so.
I get it. Yeah, I think you would come on this show from the graces of your guitar to talk about field notes, and I kind of bushwhacked you into talking about risk management. So sorry if I kind of stole your plan here. Yeah.
No. No, I honestly, ask anything. I love the conversation, so you ask me about anything.
Yeah, perfect. Well, no, you know what? I think I try to cap it in an hour. We got a couple minutes left. I might ask just the classic ending. You got a couple of picks you want to share with us that you might feel like, upcoming catalysts or stories you think that are interesting that are developing right now?
Sure. So I'll get it's the number 1 ranked company in the junior stock for premium portfolio, but I think it's a really good pick for today's world, because it's a company that I think you're going to see the share price appreciate in the next, let's say, 6 to 8 months. So the company's G Mining, ticker's GMIN. It's been a great winner for us over the last year. It really is truly a people play. The Gignac family, famously, I don't know, Louis Sr. Created a mid-tier producer back, 20, 30 years ago. I believe it was Barrick that he sold that to. And then he got into G Mining Services, which was basically an open pit engineering firm. And they constructed, open pits around the world for Newmont, for numerous companies. And then over the last probably 5 or 6 years, they've done some stuff in South America. Fruta del Norte, they made for Lundin Mining. Or actually, it wouldn't have been Lundin Mining. It would have been... it was Lundin, because Lundin bought it from Kinross. So yeah, it would have been Lundin that they would done it for. But they've done another in the Guyana Shield, which is the Greenstone Belt, where they're working right now, which is Tocantinzinho in the northern part of Brazil. And so to me, this is a people play. G Mining, has this multi-decade record of success in creating open pit mines. They're 50% through the construction right now, set for their first gold pour next summer. And I think, you see this gold price between $1,900 and $2,000. There's a nice differential that should be closed in the share price, regardless sort of any additives. They just have to finish construction successfully and on time and on budget. And that's what they've done all along. So to me, that's a beautiful play on the people and their execution over the next 6 to 8 months. On the oil side, it's a company I'm highly invested in and probably have a little bit too much of my portfolio in. But it's a company called Prospera Energy. They're based out of Calgary, and they've got two projects in Saskatchewan. I'm probably going to see them. They're drilling next week, and so I'll be visiting site. That's not field notes. That's just me going to site and checking on how things are going. And it's a developmental story. It's a really big turnaround story. A company that was in kind of disheveled over the last 2 or 3 years.
Mm-hmm.
Brought a new management team in. There's still some remnants of that. The guys that ran the company before in terms of share structure, which is not the greatest, but that's going to get wound over time. And I think realistically, this company ends up over 2,000 barrels per day by the end of the year. And I think that's a really key mark because that's basically a doubling in production from when I was invested earlier this year. And I think the upside potential, especially with, let's say, $90 per barrel oil, is really good. And of course, and I would rather this not happen, but if things in the Middle East did get worse and the oil price went up, then, that asymmetric type of play in Prospera kind of kicks in. And I'm highly biased because I do own a lot of it. So that would be my second pick. And those are two companies on both ends of the spectrum, I think, for people. And yeah, I think those are two good ones.
Yeah, without speaking too much about those details, I mean, you have to understand that the international geopolitical realities have massive ramifications on commodities, right? And so that's just so. No, Brian, it's been great. I really enjoyed it. Maybe hopefully I can get you on again in a few months' time, where you can maybe pick up where we left off, or keep going on something new. But yeah, thank you for your time, Brian.
Oh, thank you for having me, Matthew.